afternoon, this is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial. And I'm here with another monthly market update for you. So let's get started. Let me share my screen. June 16th, 2022. So it's been about 30 days since I did my last update video for you. So let's check back in with the market and take a look at what's happening. Well, the Dow, instead of being down 10%, is now down 18. The S&P 500, instead of being down 20, is down about 24, and the Nasdaq, instead of being down 30, is down about 34%. So pretty broad correction. We're now in bear market territory for most of the major stock market indices that we monitor. Proximate causes haven't changed at all. Essentially, high inflation has forced the Federal Reserve to start hiking interest rates throughout the economy to kind of slow down what I think we could all agree was probably in a rearview mirror anyway, was a superheated economy back in 2021. In addition, we're dealing with some pretty sour investor sentiment, and of course the Russian invasion of Ukraine really did have and continues to have a significant impact on food and oil prices. In other words, it has really sort of prevented a natural moderation of inflation. The economic backdrop, I'm going to highlight what's changed over the last 30 days. You know, the economy was expected to grow 3% this year 30 days ago. Now it's looking like 2.5%, according to the Federal Reserve. They just reduced their outlook. And then 2% next year, that's unchanged. Inflation is supposed to peak this year, 7%, no. Fast forward to today, 7.5%. So I think what we're really dealing with here is that inflation has been unexpectedly, persistently higher than the Fed expected, and the economy is going to have to slow a little more than they anticipated. And we'll get into that in further detail in just a minute. What hasn't changed? Well, consumer spending is still expected to rise about 3% this year. Unemployment's still pretty low, and I don't think we're expecting, mass layoffs. More people are coming off the sidelines, rejoining the workforce, and that's good. So we have some good and some bad, a lot of cross currents happening here. But I'd say, just a change over the last month. We need to be cognizant of the fact that growth is slowing perhaps a little bit more than we'd anticipated. Take a look again at the stock market chart, and not a whole lot different here. It's the chart I typically show. Now a 24% correction for the S&P 500, but it looks like to me the market seems to want to move down toward that pre-COVID peak. So we're going to go below 3,500, I think, on the S&P 500, not in a straight line. You could see a rip-roaring rally of 8 to 10% from here, and I would not be surprised. And I'll go over the reasons for that later. But I think ultimately the market does want to reset to that pre-COVID level. And I think in a lot of ways, the economy would benefit from resetting to that level. We had a lot of stimulus, as I've talked about in prior updates, unprecedented level of monetary and fiscal stimulus that really pushed demand to ridiculous levels. And now we're dealing with the hangover. We're coming down from that. The Federal Reserve is pretty steadfast in wanting to return the economy more to a normal footing. Stocks are getting cheaper. Okay, so stocks aren't just a paper certificate, right? Stocks are actually ownership shares in real companies that do real business in the real world. So these are real assets, and in my mind, just as real as real estate. So we look at the price earnings ratio again to kind of gauge how cheap or expensive the market is. And by this chart, it got pretty expensive in 2021, but with rising interest rates and a kind of a lower demand level in the economy, a return to normal, we've got to see the PE ratio here on the market fall, and it has. It's fallen quite a bit. The long-term average is about 15. That's where we are now. So this is a call we made last month that we thought it would come back down into the 15, 16 level, and here we are. And so remember, as the stock market falls, some of these good assets are just becoming cheaper. We need to talk about the path of inflation because that's really the primary factor in this investing regime. Remember, inflation is the primary issue that caused the Federal Reserve to have to tighten financial conditions. When you tighten financial conditions, it's just sort of a phrase we all use. What you're really doing is you're slowing down debt creation, you're slowing down demand, you're slowing down businesses. So the whole economy is on purpose now. It's being engineered to a lower level of activity in order to get inflation under control. And so these are two measures of inflation. The black is from the New York Federal Reserve, and the blue line is what's called core personal consumption expenditures. That is the preferred gauge monitored by the Federal Reserve. And so you can see that we are finally, perhaps, cross your fingers, starting to see inflation peak out and head lower. It's our view that inflation is probably going to fall a little faster than most on Wall Street expect. We think we have reached a peak and it will fall. But remember, right-hand side of this chart, the Fed's long-term target is 2%. We are a long way away from that. Okay, so it will take some time for it to get back down there to that preferred level. And it could be actually, according to the Fed, they're thinking probably 2 years from now is when it gets down there. I'm thinking it's probably longer than that. And the Fed is eventually going to have to recognize the fact that that old 2% regime is not good going forward. My guess is they're going to have to upgrade that to 2.5 or maybe even 3 as a target. Okay, Fed hike expectations. I showed you this chart last time, and I wish I could overlay that the last line, but I'll just tell you essentially what happened here is that in the last 30 days, expectations for the amount of interest rate hikes that the Fed is going to have to do has risen. So the expectation is for higher rates than we had 30 days ago, and that means lower stock market. And you got to understand that basic relationship right now. Higher rates in this economy right now, higher rates is going to equal, at least in the near term, lower stock prices. So this is something that definitely changed. We have a higher endpoint for where the Fed is estimated to have to stop raising rates. And I wanted to show you sort of a microcosm of what those Fed rate hikes do. Okay, so the impact is very simple in this chart. What you're doing is you're raising the 30-year fixed mortgage rate from roughly 3.2% at the beginning of the year all the way to nearly 6% as of today. And what does that do? Well, it slows the housing market, and so you get existing home sales falling, and that's the blue chart. So and that makes sense, right? I think we all realize we need to slow the housing market. It has gone gangbusters and probably moved too far. Affordability levels are extremely low, and the inventory of for sale houses has fallen to something like 2 months worth of transactions, and that's ridiculous. More normal would be 6 months. So that inventory I would expect over the next year to rise, but not a whole lot. We don't think we're facing a housing market crash, primarily because we have underbuilt housing in this country since probably 2006-07, and population growth and the millennial generation finally going to buy homes. You have a shortage. So we think that shortage is structural and that will last another several years. So we don't see a crash, but this market, just like everything else, will be slowing. Okay, so this is another thing that changed this month. A lot of fear in the market and fears of not just a slowdown, but perhaps a recession. And this chart just shows you the results of a monthly survey of consumers. And this is the sentiment survey. There's a number of different surveys, but this is a sentiment survey. How do you feel about your near-term future? And the answer is not very good at all. This is a terrible number. And this shocked the market when it came out recently. This is, by the way, this chart is now lower than it was in the worst parts of the housing crisis. Now, the great financial crisis, GFC or housing crisis, whatever you want to say, back in 2008, that was a far worse situation, I think, than we're facing now. It's my opinion. Well, we had a near meltdown of the financial system, came close to not being able to go to the ATM and pull money out. I think most of us lost about 50% of the value of our homes in a very short period of time. We saw massive companies like Lehman Brothers go belly up. So I really don't think we're anywhere close to a situation as negative as that. However, the sentiment gauges show that we're in worse shape. Okay, so in other words, investors have a really sour mood. I think consumers are in a really sour mood based on the price of gas and groceries. The price of everything is going up. We know that, I don't know, airline tickets, we're all buying them, but airline tickets are up, what, 25% year over year? That's ridiculous. These things need to come back into line. And that is why the Fed is doing what they're doing. Let's take a look at the pros and cons, or the bull and the bear case for investing in this market. So the market is, from a technical standpoint, is oversold. At least that's what a lot of traders say. It's oversold. In other words, it's come down a lot in a very short period of time. And that means that we're probably spring-loaded upward if we get any good news. Now, what could that good news be? Well, any sort of amelioration in the Russia-Ukraine situation, any situation that could drive oil prices lower like that. We could get a lower inflation reading over the next month, right? That could convince people that the Fed's rate hikes are actually working. I believe they're working faster than I think is widely appreciated. And so any good news like that would turn the market around in an absolute hurry, and it would be, you'd get those trading algorithms at the high frequency trading funds and hedge funds, the big companies. You'd get a rush in the exit that you wouldn't be able to catch up with. So that's a possibility. And I do believe, by the way, that inflation has peaked. Supply constraints will be easing, but there's two sides of this inflation, and it's demand, right? Demand, like roughly 15 to 20% higher post-COVID than it was pre-COVID. So demand, and then there's supply, and supply was constrained because of COVID shutdowns, and obviously, with Russia and Ukraine controlling about 25% of the world's wheat supply, that constrains supply for food on this end, and then the oil embargoes, right? Energy embargoes, that constrains energy. So what the Fed is trying to do is bring down the demand side, and then let time and nature bring up the supply side. And so we think that that process is already in place. I'll say that in my view, anyway, corporate earnings have been resilient thus far, very resilient, much more so than you would expect, given all the challenges that have been thrown at corporate America over the last 2 years. But the fear, okay, that's the reality, is the numbers look pretty good, but the fear is that with rising interest rates, with inflation being persistently high, that the corporate earnings are going to have to fall. So we're dealing with kind of a hard numbers versus soft numbers issue. Okay, so we haven't really seen evidence yet to suggest that we're falling headlong into recession. In fact, one of our vendors for investment research, called Ned Davis Research, still says, look, we acknowledge all the fear out there, and I'll get into the bear case in a second. All those things are legitimate, but still don't project a recession, especially not this year. So that's kind of the issue between the bull and the bear case. It's an issue of hard data. It's not so bad, but the fear is it will get worse. Finally, I think there's this idea that the Fed is at peak hawkishness. In other words, they will have to pivot. Okay, and by pivoting, I mean like back in late 2018, early 19, when the Fed said, okay, we had all these plans to do all these rate hikes, but we have to give a nod to the fact that the economy is slowing, and so we're going to pause, right? And so you could pivot, pause, whatever you say. I'm relying on the Fed's previous promise that they are data dependent, and that their intention is not to drive the economy into a deep recession. It's to get inflation down. And some say, well, those two goals kind of smash into one another, but it's our view that they will at some point see lower inflation, slower economic activity, and they will pause. The bear case is that we're already in a recession. It may not have shown up in all the data, but it's there. And it's because the Fed's getting aggressive just at the very time when consumer spending and the economy are poised to really slow rapidly. And of course, the risk is that they'll break something. That something that they're going to break could be anything. You could see a couple of high-profile companies declare bankruptcy. That's a breaking, right? You could see interest rates rise to the point where eventually the housing market breaks because borrowing rates are just too high. So that's the bear case. And I'll have to say we're right in the middle. We can't rule out the possibility of a recession. Absolutely not. Given the Fed and their intent to really knock out inflation. In fact, some people have said that the best cure for high inflation is a recession. So that's a possibility. We're just right in between. We're agnostic. I think we're positioning portfolios to account for rising risk, but we don't want to fall all the way in that bear camp because there's a lot of legitimacy in some of the points up there in the bull case. And so we are roughly neutral. We've de-risked significantly since the beginning of the year, and we continue to reassess. It's clear that the risks are rising, but we still don't see worst case scenario, although I believe the market kind of at this point wants to price in worst case. Okay, recession checklist, we'll do this again. It hasn't changed. Yes, we have an accelerating and problematic inflation problem. Yes, we have a hostile Fed. They are bent on fixing it. But I don't think we have enough concrete signs of coming economic recession to really check that off yet. I really don't think we're maybe an inch closer to that than we were last month, but that's not far enough to be really conclusive. And finally, do we have, can we check off investor exuberance and high stock market valuations? No, absolutely not. We are this bear market now has gone a long way toward alleviating those risks, so we can't check that off. And finally, I wanted to provide you a reality check, and this was part of an interview that Professor Jeremy Siegel out of the Wharton School gave today on CNBC. And he's a longtime author devoted to study of the stock market, not just in the U.S. but around the world. And so he's a respected opinion, and he acknowledges that we are not in a normal. It's not a normal market. It's not a normal time for investors. But he says fears of a recession are what's dominating the trade day to day, especially today. And as a result, he says we're undervalued. That means his stock market, he thinks at this point, is probably undervalued. It's precisely because of these terrible times that people stay out of the stocks and they go into 2 to 3% CDs, and they fail to recognize that over the last 50 years, stocks have returned about 10% a year because they can't stand the bear markets. And I think that hammers home the point that temperament is one thing, right? You've got to have the temperament to be a long-term investor, but the dollars and cents are another thing. And history shows us that if we can weather the storm, maybe lose less than the market during the worst part of a contraction, and have the fortitude to see beyond this year that it'll definitely pay off. And he was asked, why shouldn't stocks be lower? And he said, well, because they're not going to always have depressed earnings like they might this year. They're going to return to healthy levels, and when that is it the beginning of 2023? Is it the last half of 2023? Who knows? But they are going to recover. So I think this serves as a great reality check on a day like this. That's pretty dour. It might, as I said earlier, market might have to go down from here, but we think we're far closer to the bottom than the top. And this is a time when you really want to buckle down and rely on your long-term investment horizon and an all-weather portfolio. I want to thank you for listening. Put up the disclosures here. A lot of these are just our views based on our own research.